What's good, guys? It's your partner, LaDale, man. Happy Wednesday to you. Hope all is well with you and the family. I want to come in for a brief second to talk with you for a second concerning the topic of really financing in the real estate and what's going on in the retail space and the investor space. Everybody knows that we have kind of record high interest rates. I think FHA is around like 7.1%, which is not uncommon. It's higher than what it was 4 years ago. You're looking at 2 or 3%. So 7.1%. Sometimes you can go up to 8% on the FHA loan, depending on your DTI and credit score and financials. All of that is variables that you have to really understand. I want to talk to you guys real quickly about a investment technique. Is what do you do whenever, number one, the properties on the market, they have long days on market, which means it's really a buyer's market, right? Then number two is what options can investors actually offer retail buyers to where you can sell your property, but also maybe even beat an FHA mortgage interest rate. Yes, I said that correctly. Well, guys, there's a technique, that investment technique that I've been using for a long period of time that was very popular back in the day, but really is not talked about that much at all. That is the financing option of what they call seller finance or owner financing. What that essentially means is the owner of the property acts as the bank for the buyer themselves. In other words, the buyer puts down a down payment of anywhere from 5 to 10%, right? And then both the seller, which is the owner of the property, and the buyer agree to an interest rate, a promissory note, over it could be a 5, 10, 15, 20, 30-year term. It could be 30 years amortized with a 5-year balloon, 2-year balloon. You really have the wherewithal to do what you want to do if you are a owner of the property, seller financing out to a buyer. Now, how does it benefit the owner? Well, the owner gets to sell the property pretty immediately, right? And they get a down payment, so they get some cash up front, and they get a cash flow on a monthly basis. For instance, if your interest rate, if you're the buyer of the property, is around like let's say 3-4%, right? And let's say you want to offer 6% to the buyer of the property. It's not uncommon. You're making a 3% delta arbitrage there, a profit that you put in your pocket, right? That's your cash flow, because you're acting as the bank to the buyer. So you got a down payment up front, cash up front, and you get a drip of cash flow on a monthly basis. But even more so, you pass on the responsibility of taxes, insurance, and maintenance to the buyer of the property, right? Which is excellent if you are a seller of the property, right? Now, how does it benefit the buyer? Well, simple. The buyer gets to the joy of home ownership, right? They get the joy of having a pretty reasonable interest rate. And number three, the buyer also gets the joy of building equity, right? Because they put down 5-10% down, which is great, and they can pass on that property to their children. But more so, you got to qualify for this mortgage without pulling any credit at all or any financials, typically. And now I'm different. I'll still ask for some financials, but credit score, I'm not really worried about it all, because it's seller financing. So I don't know about you, if you are a buyer of a property and you get to qualify for a good functioning home without having to pull your credit, man, that is a dream. So again, there's a benefit for both the seller and the buyer. I'm gonna say this here. I believe that seller financing or owner financing may become more popular if the interest rates don't begin to come down. I'm gonna say it again. I believe that seller financing and or owner financing will become more popular as a financing tool for sellers and buyers to begin to implement if the interest rates don't come down, or if we get into a deflationary type of economy. guys, I hope this helped you out, guys. Man, and I would say this also. A good way for investors to be able to offer this type of financing services to potential buyers is to know how to acquire properties at the right price point. I say it on all my videos. You make money in real estate when you acquire real estate, not when you sell it. So if you acquire correctly, you can easily sell and finance properties at a good, reasonable price point and a good interest rate to where it is attractive to a seller. All right, guys, just so happens your partner is offering a free ebook. It's free. It's is distressed property investing. It teaches you how to acquire distressed properties in your city, county, or state. Easy. Again, you make money when you acquire real estate, not when you sell. And I believe you should know how to do this for free. It's a free ebook. But guys, I hope this blesses you. I hope I added some value to you on this Wednesday. But guys, stay blessed. Holler at your partner, and I'll see you on the next deal. God bless you. Peace.
Okay, so you did fixes and flips first, or were they? Now it sounds like you're more buy and hold. Okay, so you're wholesaling first. Okay,
because I was broke. I had no credit. I had no money. So I had to get some money coming in. So I learned how to do wholesale.
And you were doing wholesaling at the good time too.
2000.
When it wasn't so saturated. There was.
I kind of saw the debacle coming.
Okay.
It didn't make any sense. I was like, wait a minute. How can you lend out to retail buyers 99.7%?
Yeah.
Just a little bit of a down tick. It's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes.
Yeah.
Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
08, 09. That's why I made that lion's share of my money.
Wow. Okay.
Actually running from the cows, I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He didn't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal, but keep the lion's share of the cash flow?
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy and hold a lot of properties. Now watch this. I actually buy a lot of properties. I take home money when I actually acquire it. Every single time.
Okay, you need to break that down just a little bit.
If you wanted to know how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below or swipe up and download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed, holler at your partner, and download the ebook today.